Good evening, everyone. My name is Eki Gutierrez, and I'm here to talk to y'all about my Finance 451 project. So we're going to be comparing 10 different companies in 2 different industries. So it's going to be pretty fun. Go ahead, forward. So my 2 different industries are the entertainment industry and the beverages industry. They're 2 different industries, but they have similar qualities. So before I talk about each and every company, I want to give a brief overview of each industry and just kind of give you a historical background on them. So the entertainment industry typically has a low economic value added, and the beverages industry typically has a low return on assets. So keep that in mind when we go forward in evaluating each and every company. So let's talk first about 21st Century Fox. It's headquartered in New York City, New York, and you're going to see in all of these entertainment companies, they're mostly based in New York and California. The entertainment industry has always been dear to my heart because I am a dancer by trade, and so I visited both New York and California as a dancer, and so the entertainment industry just excites me. So let's talk more about 21st Century Fox. It is a media and entertainment company, so it's most known for its movies, television networks, and news networks. Go ahead. So its biggest strength is that it has a really high enterprise value compared to the industry. So you can see in this line how it's gradually increasing, and it's got a pretty high growth rate compared to the industry average. So we all know that an enterprise value is a great source, or an enterprise value is a great way to determine firm value because it also includes debt into your calculation. So not many firm value calculations include debt, and it's a great tool to have. So let's talk about my second company, Viacom. Viacom is very diverse. It's got a whole bunch of divisions within the company. So they all kind of have the same background, but it is a pretty diverse company. It includes a lot of movies, applications, games, social network things, television. So it's got their hands dipped in a lot of different places. Go ahead. So Viacom's biggest strength is that it's got a pretty high economic value added, unlike Fox. So that means they can cover their cost of capital pretty well, and that frees up a lot of money for reinvesting into the company, which frees up growth. So Viacom's biggest weakness is that they have a really low asset efficiency, which of course means that they don't manage their assets well, and it really reflects on the management of Viacom. So let's hope that they get that up. So let's talk about my third company, Lionsgate. It's very different from Viacom and Fox because it's not that big of a company. It's headquartered in Santa Monica, California. Again, one of those companies that's headquartered in California or New York. It's not as diversified as the other companies because it only includes like motion pictures and television programs. But with their non-diversification, they still have some strengths. So let's talk about their strengths. So their biggest strength is their equity multiplier. You can see that it's way above the industry. The industry kind of is flat. There's not much change, and it's actually decreasing at the end. But you can see it's much higher toward different years, and within the last 5 years, it's always stayed above the industry. So with a high equity multiplier, that means it's more levered than most other companies in the industry. With more leverage comes more risk, but also comes more return. Go ahead. But with that low risk, or with that high risk, the real weakness is that they have a really low ROE. We all know ROE is a very important ratio. So we have to watch that ROE, and it's really saying that the company isn't generating earnings from their shareholders' funds. So that's a real problem within the company.
Cool.
Yep. So next is the CBS Corporation. If you watch TV, it's all over. It's headquartered in New York City, New York, another New York company. And it focuses mostly on cable and local broadcasting, but it also has a lot of different radio stations, and I think it's 126, yep, 126 radio stations. Go ahead. So their biggest strength is that they have a really high PE ratio. So that means investors are expecting higher earnings in the future for the company, which is great. It's a great thing to look forward for the company. Go ahead, Maya. So their biggest weakness is that they have a really low equity multiplier. That means that they have more equity than debt. So if you're a risk-averse investor, that's good for you because they're just consistent and they might not have high returns, but you're not taking too much risk on the company. So that could be good for some people and bad for others. So my last company in the entertainment industry is Scripps Networks Interactive. It's headquartered in Knoxville, Tennessee, so it's much different from the other four because they're usually based in New York or California. But it's best known for its popular television networks, and I think its most popular television network is the Food Network. It also sells videos, books, kitchenware, and tools, so it's a lot of it. They are trying to diversify, but probably not as much as the other companies. Go ahead. So its biggest strength is that it has a really high ROE. You can see it kind of dip down below the industry average, but it's stayed pretty high for 3 of the 5 years, which is great for a company. ROE is a very important ratio. It's said to be the most important accounting ratio. So it signifies that they have used investors' funds for the greater good of the company and to maximize their wealth. So that's great. So a weakness in the company is that they do have a much smaller enterprise value than all of the rest of the companies in the industry, which could be good, could be bad. I see it as there's a lot of potential for growth. So depends on how you look at it. So let's look at Coke's biggest strength. Coke's biggest strength is that it has a really high profit margin compared to the industry. And with a really high profit margin comes a really good advantage, a really good cost advantage compared to the other companies in the industry. But they do have a weakness like all companies do. Go ahead, Amelia. JP. They do have a weakness as all companies do. They have a really low asset efficiency. Everyone knows what that means. It means they're not using their assets very well. So they need to get that up in order to have more growth potential for their investors. Go ahead. So next is Dr. Pepper Snapple. It's headquartered in Plano, Texas. So it distributes non-alcoholic beverages just like Coke does, but it only distributes in a certain amount of places. So it distributes in US, Canada, Mexico, and the Caribbean. So let's look at Dr. Pepper's biggest weakness. That would be their low price to earnings ratio. It's not that much of a difference compared to the industry, but it might be enough to deter investors away from the company. We all know that low PE ratio means a low growth rate. So it might scare off investors. It might not be that much of a big deal. But let's look at our next company. Our next company is Monster Beverage Corporation. They actually have a lot of strengths. I was surprised. But they're headquartered in Corona, California, and they focus primarily on energy drinks. So they, and even their other products that they have, they mix their energy drinks with their products. So they might have coffee and energy or protein and energy. They just mix energy drinks with a whole bunch of different drinks, and it obviously appeals to the public. So let's talk about the biggest strength of Monster. They do have a lot of strengths, but let's talk about the biggest. It is that they have a really high ROA compared to everything, and that is return on assets, by the way. Compared to the industry, they do have a high ROA, and that means that the company is earning more with less investment, and they're utilizing their assets efficiently. So that's great for the company. So let's look at Monster's biggest weakness, is that they have a high equity multiplier compared to the industry. Some investors might not like that, some investors might. That just means that they are more risky, but they do have a higher return. I personally wouldn't be affected by this because Monster has so many strengths and so many great ratios that it might cancel this little ratio out. So let's look at the next one. Jones Soda Company, not a very big company at all, but it still does have some strengths and some weaknesses. It's headquartered in Seattle, Washington. It's not very diversified because it only sells in North America. So it doesn't sell around the world like the big Coke company does. Let's look at their strengths. Their strength is that they have a really high current ratio compared to the industry. With a really high current ratio, it means that they are a very liquid company, and it gives a sense of efficiency for the company's operating cycle. So that's great. So let's talk about their biggest weakness. Their biggest weakness is that they have a really low return on equity compared to the industry. You can see, they haven't even been positive in the last 5 years. So that's really not good. We all know return on equity is a really important ratio. So that might scare investors away. Go ahead. The last company I'm going to talk about is Reed's Incorporated. Some of y'all might have heard of it. Some of y'all might have seen that logo right there. It's not a very popular company. They don't sell that many things, like 24 different drinks and 4 different candies and 3 different ice creams. They're not very diversified, but they do sell around the world. They sell in United States, Canada, Asia, and Europe. And they're headquartered in Los Angeles, California. So let's look at their strengths. So Reed's Incorporated's biggest strength is that they have a high equity multiplier compared to the industry. And that could be a good thing, could be a bad thing. We all know that the equity multiplier directly correlates to high risk and high return. So it just depends on what type of investor they are. Let's look at their weaknesses. They do have a high market to book value. So that means, you can see that the industry has kind of been consistent and Reed's has been all over. But, look how high that is compared to that. That means that they are probably overvalued, which I'm surprised since they are such a small company, but that's not really good for them that they're overvalued. So let's go on. I'm going to talk about which companies I personally would invest in. Go ahead. I personally would invest in Scripps and Monster. Scripps has a high current ratio, high times interest earned ratio, high profit margin, high return on equity, and high return on assets. And actually, it was the highest in the industry of all of those ratios. So that's great. And also, Monster Beverage had pretty much the highest in all of those, except add price earnings ratio. So with the price earnings ratio, we know that means high growth for the company and high returns for investors. So thank you very much for listening. I hope you enjoyed it, and God bless.